Hi, Philip. Thanks so much for joining me today. I would love to dive into a bit of your background before we get started.
Sure. Hi, Maddie, and glad to be on. Um, my background: I'm originally from Norway. Currently live in Switzerland, where I am the CEO and chairman of this startup called Frigg. I have a background in mathematics, but quickly went into working for a traditional financial intermediary after my studies. And also was dabbling about in the private infrastructure space for quite some time before founding Frigg.
That's awesome. And do you want to give a little bit of background on what Frigg does?
Sure. So we're building a marketplace where we connect renewable energy projects with institutional investors. And very simply put, we're building, or maybe not simply put, but we're building a primary market issuance platform for equity or debt securities issued on the back of these renewable SPVs. And we have developed a streamlined workflow for developers to walk through the documentation stage, the rating of these assets, and ultimately connecting them to financial investors on the other side, which predominantly consists of institutional investors at the current stage.
Awesome. And can you give maybe some examples of different projects that are on the platform?
Yeah, sure. So we're still a bit in stealth mode intentionally, because we don't want to fall into this famous chicken and egg trap. So we're cautiously building up the project pipeline while we simultaneously match it within investor demand. And the current projects that we have in pipeline are predominantly in the renewable energy space. And within that, it's going to be solar. It's going to be small-scale hydro and waste to energy. Those are sort of the three project buckets that we're currently working on. And we see, at least from our perspective, a major opportunity, especially in the solar space, where costs have significantly decreased on the production of these panels, and hence also yielding relation to revenue, more output. So these projects seems to be also in high demand and appetite by the investor side.
Yeah, I was speaking to someone the other day who was saying how a lot of renewable energy is actually a really good investment opportunity in terms of like the yields, especially when you're providing debt. Have you found an increased demand from investors looking at renewable energy?
Absolutely. However, this asset class in a whole, has been historically more geared towards long-term traditional investors. But you're right, there are obviously subset categories within the renewable segment that might be more applicable for, let's say, a shorter-term investor looking for yield and cash flow generation earlier on in the life cycle. And that's also why I mentioned solar, because the building time is relatively quick. So the period on which you actually start to seeing cash flow back is quite short. But other infrastructure projects that we're looking at, as an example, more in the hydro space, small scale hydro even, has sometimes quite long building times, up until 24 months for some of the, let's say, medium-sized projects that we're looking for. And hence, as an investor, you need to wait a bit longer for it to generate cash flow. But when it then comes, it's quite stable compared to solar, which is a variable renewable energy source. But yeah, absolutely, we see massive demand inbound coming from various types of investors that are not only interested in, the stable cash flow, but also a hedge against the, let's say, traditional capital markets, because here you have offtake agreements that are fixed price, delivering the only volatility there inherent in the cash flow generation is the production. So you have more environmental exposure actually than traditional capital market exposure.
Interesting. And what type of investment products are you offering? Is it debt or is it equity that these companies are raising?
Yeah, that's a great question. We originally started out just focusing on debt, simply because from a legal perspective, from a structural perspective, it's easier to bring that on chain. But we've since the launch of our proof of concept, which we did back in 2022, also geared the platform towards catering for equity as well, because investors seem willing to take that additional risk, and hence we do cater for both. However, we do think that if we are building a platform where investors sit very far from the assets, we are globally agnostic, then it might be better structure to have the developers that are actually building the assets being retained as an asset owner, so that they also have skin in the game. Because then, as an investor, you don't actually go there to the asset and knock on the panels and operate it. You need someone to do that, right?
And what type of, I guess, annual returns can investors expect? Which also leads into what type of investors are you targeting?
Obviously, that depends very much on region. And the assets that we're currently onboarding, they're predominantly in Europe, Central Europe, and we also have some projects in Singapore. The size of these projects, they vary between $1 to $20 million in investment, so each project size. So we're talking here the smaller segment, which I think before answering the question related to return is important to realize, because that's a bit of an unexplored bucket of projects when you look at how these normally go through the value chain. They're simply too small to get financed by the traditional financial industry because the overhead is too high. And hence, these developers are willing to pay a higher premium on getting a financing for these projects. So the yield that we're currently looking into for these projects, they lie between 8% in more, let's say, very established markets, operational projects, all the way up to 12% on the debt for more, let's say, project finance applicable assets.
And I'm assuming it's more institutional investors that you're targeting rather than angels or retail investors.
Yes, that is right. We do see a stronger fit at our current stage with investors that want to buy and hold, at least for a period of time. But we do also want to build and bridge that, let's say, risk life cycle of a project. Very early project development, have investors that are willing to take high risk, might sit, 1 or 2 years and then want to sell off. Now, currently, the transfer of ownership of debt or equity securities tied to these assets is quite cumbersome. But we do also see a shift, from more institutional expert capital being deployed earlier and more retail facing capital on the later stage of the asset lifecycle. So you can imagine us bridging that risk lifecycle of a project by simply having institutional investors come in first, taking that initial risk, and then we help the institutional investors sell off their ownership in a later stage of the asset lifecycle.
Okay. So do you also provide the secondary market infrastructure for that transaction to take place?
That is a great question. We do not at the moment. What we can cater for is peer-to-peer transactions. So you would just establish a new account, and it will be a bilateral agreement between those two investors on the sell price. But we do have plans to integrate with exchanges so that we can dock in these securities there. But we do target predominantly regulated exchanges, and we see there that we're still quite early when it comes to securities on chain, especially backed by real world assets. And we're talking here like renewable energy assets and not tokenized bonds or treasuries. So it's a different ballgame. And we might see that we need to gear up with institutional, long hold investors before we actually materialize on our plans for docking into exchanges.
I've also found something very similar. I've recently been speaking to some exchanges about a regulated securities token, and we've also found very similar feedback. I think because it is such an early industry and the regulation isn't that clear, they're also confused about how to approach it. And I guess on that note, like, how have you found institutions adopting like blockchain investment products? Have you seen a lot of interest or questions on that front?
Yeah, I have a long story to talk about that, maybe for another session. But as being based in Switzerland, we feel regulators are being very much innovative on regulating this topic, and hence institutions have followed. And there is definitely interest. And we've actually had some very serious discussions with 3 banks already in Switzerland. Discussions were ongoing for between 6 to 8 months, and we were very close to doing something together. But there is still a lot of hesitation and uncertainty, especially pertaining to the demand on the other side. Because, well, the questions that we often have gotten, or the skepticism, if that's even a word, from these institutions, is that, well, these traditional investors in that particular market, they don't yet see the benefit of having this on the blockchain. And hence, from that perspective, it seems to me like, although there is interest, the adoption hasn't fully happened, meaning the investors won't realize the benefits before the infrastructure is in place. And hence there it feels like at least the banks here in Switzerland are lagging a little bit behind. Although we see all these news about, custody solutions being integrated, etc. But that's more for cryptocurrencies rather than actually tokenized real world assets and renewables. Yeah.
That's interesting. Because I have seen a lot of regulations coming out of Switzerland. It looks like they're trying to take a very forward-thinking stance, which contrasts a lot of other regulators, especially the US at the moment.
Absolutely. No, we do feel quite fortunate to be based out of Switzerland and see that as a regulatory arbitrage opportunity. We also see that as a result of that, a lot of actually American-based VCs in the crypto space are exposing themselves to startups in Europe, especially exactly for that reason, right? Because there is a lot of regulatory uncertainties in the States. So they're using Europe as a hub to invest in, let's say, blockchain-based startups that are under a mantle of more certain regulatory framework. But I think regions outside Switzerland is also catching up. MiCA regulation, the EU, definitely on par with Swiss DLT regulation. So I think we'll see a lot of change going to happen on the institutional side this year and next.
I mean, hopefully with the ETF coming in, and now like you're seeing more and more institutions, like I know everyone quotes BlackRock, but you're seeing a lot more interest happening because of like the things that are being said and what's being spoken about. A lot of the early stage founders that I do speak to, one of their biggest concerns is like the regulatory side. How do you think about, I guess, building and then also maintaining that legal clarity? Like, what is the balance, do you think, for you?
Yeah, that's a daily headache for sure. And we're trying here to play a dual strategy. While we thoroughly and genuinely believe that this is going to be the future, that everything will be tokenized and the core infrastructure will be blockchain based, we need to cater for this interim step. And by doing that, we're looking into also TradFi securitization structures that is already well established, so that we can at least start to build traction and get the funds channeled to the underlying assets. And which form and shape that it takes in the front, if that's a traditional financial product that is well established, then that's fine for us. But in the back end, we do actually tokenize everything, so that the investors and the issuers, they can reap the benefits of the technology once it's mature enough. But for the moment, it's pulled very much into the back end.
Okay, and I assume that, I guess, like the bonds that you're tokenizing are bonds that have been certified by, like, I guess, the government or that entity, and then you tokenize that bond rather than going directly to the blockchain.
No, actually, we tokenize all the way back to the senior debt tranche of the SPV itself. So you have to imagine there is a funding need that is needed for the project. It's wrapped into a legal entity, and the senior or the debt element of that financing, that's what we tokenize or securitize. So it doesn't take the shape of a bond necessarily. It's a traditional loan, but once we list it, or it's channeled through the various financial workflows, then yes, ultimately it can become a bond where the issuer doesn't have to pay amortization amounts before the end of the term and just interest.
Okay, I think a lot of current tokenizations are taking that approach of tokenizing an SPV, like the norm at the moment. So in terms of the platform, essentially you're building a marketplace. So how do you think about the chicken and egg problem? Because I know that I also speak to a lot of founders that have this at the top of their mind. So how have you, I guess, strategized to be able to solve it?
I think we're quickly entering here into the topics of law of large numbers. I think we just need to, be quite broad on both sides. And that's what we've been doing now for the past year, really being broad on the sourcing of projects, being broad on the investor acquisition side, and done a bit of almost tendering in the back, matchmaking which projects do the investors want to see. It has to do with risk profile, it has to do with return profiles, it has to do with asset class within the renewable segment, life cycle of the project. And obviously, it's super hard for a startup in our stage to build traction from the beginning. But we do have secured some commitments on the financing side. And now we're just carefully selecting and vetting the asset side before we pair it up with that capital that we have gotten committed. So we have gone about it to really secure a credit line. We've described sort of what we want to build. And build a relationship with the investor or investors, and gain their trust in how we're very diligently mitigating risk and selecting the assets before the funds are actually being deployed.
Okay, so you've essentially built the supply, and now you're curating the demand. How do you then think about, once you've, I guess, got like your first few investment deals funded, how then do you think about scaling the demand for that?
So we necessarily want to remain a tech platform, and hence building up a huge marketing team to source new investors or deals. That doesn't make a lot of sense. So we need to build partnerships with what we call distribution channels that can digest that workload and actually see a lot of synergetic fit, because they might not have the tech stack and the lean setup that we currently have within our company. So we see opportunities partnering with traditional financial intermediaries that see it as an edge of having an efficient way of sourcing new deals in this particular segment, having a software wrapper around it to track and monitor the performance of the assets, but that their job is really to do distribution and investor acquisition. So we can only focus on the one side of the equation.
Yeah, I think that's the right approach. I was just listening to a podcast and a founder was building a crowdfunding platform. And initially they were doing both the supply and the demand, and they found it really difficult to build up the demand. But one day a project came to them and was just like, hey, can I just use your software? I already have the investors, and just pay you a fee for it. And that was the birth of the new business model, because it meant that they only needed to focus on the supply rather than the demand, which I think is I guess the approach you're also trying to take here.
Absolutely. And we don't want to fall into the trap of, stagnating when it comes to volume, because the developers that we have in our ecosystem, they normally have a deal flow of between 10 to 50 million a year. And you need volume or demand to digest that volume. And there is no, I would say, upside limit as to where it can go, but we need that outlet channel. And we think it has to be an institution. And we can't do sort of this crowdfunding play because simply the deal size are too large.
It's also the phenomenon of B2B versus B2C. Like B2B is a lot easier realistically. What are you guys excited about in the renewable energy space?
I'm really excited about being able to move the needle, because when we talk about, from a more holistic perspective, we have these sustainability goals, and when you break it down into numbers and look at what the renewable segment can contribute, it's very, very fascinating and motivating to work within that space, that it can actually help move the needle. And that I think is the most motivational also spirit in the team, actually, that we're all geared by having the opportunity to contribute in that sense. It's a volume game in the end. I mean, these developers, they need funding for their projects. We know that small to medium-sized projects or anything below $100 million is not easily funded. So there is a huge deal flow that can be inbound. And that's also where in the more developed markets, the potential lies. Because to a large extent, these larger projects have already been developed. So there needs to be a solution in exactly that space. And having the ability to move the needle on a more aggregate level is very inspiring.
How do you think about evaluating renewable projects? That is a world that I don't know much about.
In my view, or in our view, renewables are quite simple. They're producing one single commodity. It's electricity. They're getting paid for it. That goes into the project, and it has also some operational cost. It has some financial costs, pays out the debt investor, and then there is some dividend out of that. So the cash flow streams is very easy to understand, and hence I think from a valuation perspective should become very easy for an investor to do that valuation. But I think the problem in this segment and why the question arises and why it's from the outskirts so difficult to do is that it's so intransparent. Like, there is literally very little information about operational history of an asset. I mean, developers aren't known for sharing this. And that's also why we have this greenwashing trend, right, ultimately down the value chain, because no one can really pinpoint on exact numbers what has been the environmental benefit or even the cash flow, the revenue generation. So I think we have a very, very important role in trying to break a bit this traditional silo and open it up so that these questions don't arise, because it is actually quite simple. It's much simpler in our view to evaluate a renewable energy asset compared to a company, which has subsidiaries and different revenue streams and different cost elements. So it's quite straightforward.
Okay, I can imagine that. What do you see the biggest risks being with investing in renewable energy?
Again, here it depends on which life cycle the project is in. If it's very early stage, then you have multiple risks. Project development risk, something can go wrong during construction, getting all the agreements in place, etc. We've decided to forego that biggest risk now at the beginning, at least, and only focusing on operational assets that have been fully equity financed and we can refinance with loans. And hence you have different types of risk, and there the main risk that we see for these operational assets is operational production volatility. Like, does the sun shine? Does the water flow? And assessing that risk and how much operational history do you actually have to ascertain the risk that is inherent.
That's really interesting. I was listening to a podcast recently, and it was speaking about natural disasters, and how even now, like, because the climate is changing at such a fast rate, or like the sea is warming, it means that prediction models that have been built up in the past sometimes don't predict the events when they're going to happen, because you're having such outliers almost happen because of these fast changing like temperatures and everything like that. Like, is that also like a risk within like the investment side of things? Because if it is very dependent on weather, climate, and things like that.
Absolutely. It's very much correlated because, as I said initially, you're not taking traditional capital market risk here. You're taking actually environmental risk more than anything, because the only volatility here is, okay, you can argue that there is some financial uncertainty pertaining to the offtake agreement, right? If it's a utility, it is ultimately connected to the capital markets and financial ecosystem. But ultimately, what drives the revenue stream of these assets is environmentally anchored. It's sun for solar, it's water for hydro, it's wind for wind, and this has this is absolutely linked to climate disasters and uncertainty and volatility, and definitely something that even becomes a bit philosophical, because we're talking to investors that want to change or improve the environment. And when you look at it from a financial perspective, we did actually a research on this in Switzerland, that the warmer it gets, the more ice is melted from the glaciers. Hence, you have more water available to produce electricity. So you have actually an incentive for investors to accelerate climate change, because it improves the financial viability of a hydro project, because there is more water availability, which is a bit counterintuitive, because you want investors to actually invest to avoid climate change. And this is obviously very regional dependent, but there you immediately see that there is a very complex environmental impact on the projects that might be in the positive of financial returns. And ultimately, investors are, looking for that, additional BIP or additional performance. And hence, in some regions, they might be incentivized to actually let climate change do its course. But obviously, that's not what we want.
So you said that you studied maths. How do you think you, like, on a daily basis, use that mathematical logic and, I guess, framing within your thinking and how you approach different situations in business? Has it helped, or do you apply it on a daily basis?
I would definitely say so. While I don't necessarily apply all the let's say mathematical equations and models, I definitely think that the structured line of thinking and process thinking has helped a lot. And at our current stage, we need to do a bit of everything. And having a very broad set of capabilities, not only for myself, but within the team, has proven extremely useful. As an example, we're doing everything from really sourcing satellite data to assess solar radiation for a particular project in Singapore. We're doing Monte Carlo simulations on the output. We're coupling it with financial models and building them ourselves to help developers. We're interacting with manufacturers to reduce the, overhead or margins that suppliers of panels here in Europe are adding to improve economic viability. And we're all the way on the other side of the value chain, talking to investors on how they should assess it, de-risk it, which rating elements should we involve, insurances that we should impose. So we are actually doing a lot of work on the broader side of that value chain, and hence having a process thinking and being able to connect all the dots is extremely important.
And how big is your team to support all of that?
So we're at the moment 11 people. And half of which are tech focused, full stack tech engineers from blockchain, DevOps, front end development, product development. And then the other half is more from the insurance industry, private equity and debt, and renewables industry specifically. So we're sort of closely the sales team, if I call it like that. So the more the business associated people, they're on the front. They're channeling information into the product team that continuously evolves the platform.
And so over the next 12 months, what are your key priorities?
So is really doing the tendering, as we call it, in the back, getting these deals closed. We're currently in the stage of documenting and thoroughly vetting the deals before funds are channeled. And then we're going to launch and go out of stealth mode with live deals onto the platform, probably around Q2, Q3 this year. But we are not in a hurry and wants to focus on quality rather than quantity. So once we are finished with that, we can go around with our briefcase filled with this tool and really show people what we're building, because the learning curve is still very steep for players in this ecosystem.
I can imagine. And how do you think about getting in front of the right investors? Is that mainly, do you do it through network, through business development initiatives? How do you think about doing that?
Yes, it's only through own network. That's where we've seen the best and most traction, warm intros, referrals, and just walking through our ecosystem there to find the right investor at this stage. Someone, we're talking to investors on the platform level, so investors that are interested in the tech and what we're building. We're talking to investors that are interested in the assets, but an ideal investor would have an interest in both, because then you can really bootstrap the whole ecosystem and what we're building.
And how do you think about building those relationships in terms of networking?
In business, there is this saying, you always meet each other twice. So we upheld ourselves with a quite high standard of quality of all the conversations that we're doing, how we're going about it, how we're thinking about risk, and really having a quality team supporting that. So we've sensed that also from the investors that we talk to and players in general, that they actually talk nicely about us to other third parties, and hence it becomes easier then to reach them as we meet them twice and they've heard about us and in a good setting, and that's obviously very helpful.
Is there anything that you want to share about how people can get involved or support what you guys are doing at Frigg?
Yeah, sure. I mean, we're always looking for partners, and while we are doing a more institutional play, we're open to discuss with everyone. I think our core focus at the time being is really looking for new projects, good projects in low risk stages. We're looking for investors to talk to, predominantly investors that are in the renewable space, have a bit of an innovative flair, and if people in that's one of those segments or both have an interest in contacting us, we're definitely here. Even my private number is on the website, so if people want, they can call me.
Awesome. Well, thanks so much for joining me today, Philip. I have really enjoyed this conversation.
Likewise, Maddie. Thank you for having me.
Awesome.